How I eliminated 30% drawdowns with this hedging approach. These numbers change how I trade. In 2008, my account ended minus $125,000 net before I started hedging. I had huge swings and sleepless nights. And today, inside my PL5 Pro live trading, my max drawdowns have stayed in the low double digits, around 10 to 15%. And on August 5th, 2024, a full crash day, my portfolio finished up about 8%. I'm Karl Domm, and in the next 10 minutes, I'm going to show you the exact hedging approach that made the difference. Real trades, real risk graphs, and not theory. And if you sell option premium and you want it hedged from day one, my safe wheel training shows you how to pair income protection with hedging, and it's free. There's a link in the description. Years ago, I did what most premium sellers do. Iron condor, short spreads, naked options, small, steady wins until volatility shows up. In 2008, I had my wake-up call. I watched my P&L on my screen bleed and I froze. Without the hedge, without position sizing on margin, the bleeding, it didn't stop. In that one day, I ended minus $125,000 net in negative net liquidation. That was the moment I learned something permanent. Profitability without protection is borrowed time. I needed a hedge that's proactive, financed by the structure, and simple to execute with one-ticket orders. I use a broken wing butterfly in the put wing with a long tail 20 to 35% below the price. The short premium finances the tail, and the entire structure goes on and comes off as one order. The long tail makes me long volatility during crashes, and the body pays for the protection. And because the hedge is on from the beginning, I never pay that panic pricing for hedges. I place these on index underlyings like SPX/ES or SPY so the hedge responds to market shocks. And I don't hedge reactively, and I have the hedge on before the move. That way, when the market crashes, I already have my protection in place. And this is not a back testing. This is my PL5 Pro live trading. The max drawdowns have stayed around 10 to 15% instead of the catastrophic hits that I used to take. On August 5th, 2024, when most premium sellers were down hard, my real money portfolio finished up 8% because the tail was already there and VAMA did the work. It's not just me. One PL5 Pro trader, George, reported over a $55,000 profit in 2024 trading with the rules. Yes, protection costs something, but here's the trade-off. No hedge means higher returns in calm markets, but a 30 to 40% drawdowns when volatility spikes. And a 30% drawdown requires a 43% gain just to get back to even. And with a proactive hedge, the average return is slightly lower, but the worst drawdowns are limited to low double digits. And the crash days can actually come out net positive. Compounding favors the account that doesn't crater. So how do you implement this? Well, step one, you build the hedge into the trade on day one. Step two, use income trades and hedges on SPX/ES and SPY to make sure index hedges covers the portfolio shock. In step three, know your maximum acceptable loss ahead of time and design the tail so volatility works in your favor when the market breaks. And the biggest mistakes are waiting to hedge, trying to hedge every position separately or using multi-ticket hedges that you can't exit, and using shallow tails that don't use leverage as well in real panics. When I stopped trying to out-adjust a crash and started engineering for it proactively, everything changed. The finance broken wing butterfly with a deep tail turned volatility from a threat into a tool. And that's how you reduce drawdowns and stay in the game long enough to compound. Now, if you sell premium and you want it to be hedged from day one, I recommend my Safe Wheel course. It's free right now for a limited time. There's a link in the description. There's a specific market mechanic that turns a quiet hedge into a profit engine during panics. And it's something that nobody even really knows or talks about. Click on the screen to the next video to see it explained.